How to start investing in cryptocurrency, a guide for beginners. Cryptocurrencies have been enormously volatile since being introduced, but that volatility can create opportunities for profit if you are looking to trade as digital assets. Cryptos such as Bitcoin and Ethereum have risen a lot since their debut, but are down significantly from their high along with other popular digital currencies. Experienced traders have been speculating on cryptocurrencies for years. But can you get started if you are new to the crypto market? Here's how to start investing in cryptocurrency and the significant risk you need to watch out for. First thing, you are looking to invest in crypto. You need to have all your finances in order. That means having an emergency fund in place, a manageable level of debt, and ideally a diversified portfolio of investments. Your crypto investments can become one more part of your portfolio. One that helps raise your total returns hopefully. Pay attention to these 5 other things as you are starting to invest in cryptocurrencies. Number 1. Understand what you are investing in. As you would for any investment, understand exactly what you are investing in. You are buying stocks, it's important to read the annual report and other SEC filings to analyze the companies truly. Plan to do the same with cryptocurrencies since there are literally thousands of them. They all function differently and new ones are being created every day. You need to understand investments case for each trade. In the case of many cryptocurrencies, they are backed by nothing at all, neither hard assets nor cash flow of an underlying entity. That's the case for Bitcoin, for example, where investors really exclusively want someone paying more for the assets than they paid for it. In the other words, unlike stock, where a company can grow its profits and drive returns for you that way, many crypto assets must rally on the market, becoming more optimistic and bullish for you to profit. Some of the most popular coins include Ethereum, Dogecoin, Cardano, and XRP. So, before investing, understand the potential upside and downside. If your financial investment is not backed by an asset or cash flow, it could end up being worth nothing. Number 2. Remember, the past is past. A mistake that many investors make is looking at the past and extrapolating that to the future. Yes, Bitcoin used to be worth pennies, but now worth much more. The key question, however, is will that growth continue into the future, even it's not at quite the meteoric rate? Investors look to the future, not to what an asset has done in the past. What will you drive future returns? Traders buying a cryptocurrency today need tomorrow's gains, not yesterday's. Number 3. Was that volatility? The prices cryptocurrencies are about as volatile as an asset can get. They could drop quickly in seconds or nothing more than a rumor that ends up proving baseless. That can be great for sophisticated investors who can execute trade rapidly or who have a solid grasp on the market's fundamentals, how the market is trending and where it could go. For new investors without the skill or the high-powered algorithms that direct these trades, it's minefield. Volatility is a game for high-powered Wall Street traders, each of whom is trying to outgun other deep-pocketed investors. A new investor can easily get crushed by the volatility. That's because volatility shakes out traders, especially beginners, who get scared. Meanwhile, other traders may step and buy on the cheap. In short, volatility can sophisticated traders buy low and sell high, while inexperienced investors buy high and sell low. Number 4. Manage your risk. If you are trading any assets on a short-term basis, you need to manage your risk, and that can be especially true with volatile assets such as cryptocurrency. So, as a newer trade, you will need to understand how best to manage risk and develop a process that helps you mitigate losses. And that process can vary from individual to individual. Risk management for a long-term investor might simply be never selling, regardless of the price. The long-term mentality allows the investor to stick with the position. Risk management for a short-term trader, however, might be setting strict rules on when to sell, such as when an investment has fallen 10%. The trader then strictly follows the rule so that a relatively small decline doesn't become a crushing loss later. Newer traders should consider setting aside a certain amount of trading money and then using only portion of it, at least at first. If a position moves against them, they will still have money in reserve to trade with later. The ultimate point is that you can trade if you don't have any money. So keeping some money in reserve means you will always have a bankroll to fund your trading. It's important to manage risk, but that will come at an emotional cost. Selling a losing position hurts, but doing so can help you avoid worse losses later. Number 5. Don't invest more than you can afford to lose. Finally, it's important to avoid putting money that you need into speculative assets. If you can't afford to lose all of it, you can't afford to put into risky assets such as cryptocurrency or other speculative assets for that matter. Whether it's a down payment for a house or an important upcoming purchase, money that you need in the next few years should be kept in safe accounts so that it's there when you need it. And if you are looking for an absolutely sure return, your best option is to pay off debt you are guaranteed to earn. Whatever interest rate you are paying on the debt, you can't lose there. Finally, don't overlook the security of any exchange or broker you are using. You may own the assets legally, but someone still has to secure them, and their security needs to be tight. If they don't think their cryptocurrency is properly secured, some traders choose to invest a crypto wallet to hold their coins offline so they are inaccessible to hackers or others. Others way to invest cryptocurrency. While investing directly in cryptocurrency may be the most popular way to do, traders have other ways to get into the crypto game, some more directly than others. This includes crypto futures. Futures are another way to wager on the price swing in Bitcoin, and futures allows you to use the power of levers to generate massive returns. Futures are a fast-moving market and exacerbate the already volatile moves in crypto. Crypto funds. A few crypto funds also exist that allow you to wager on the price swing in Bitcoin, Ethereum, as well as a few other altcoins. So they can be an easy way to buy crypto through a fund-like product. Crypto exchange or broker stock. Buying a stock in a company that's poised to profit on the rise of cryptocurrency regardless of the winner could be an interesting option. 2. And there's potential in an exchange such as Coinbase or brokers such as Robinhood, which drives a huge chunk of its revenues from crypto trading. Blockchain ETFs. A blockchain ETF always allows you to invest in the companies that may profit from the emergence of blockchain technology. The top blockchain ETFs give you exposure to some of the key publicly traded companies in the space. But it's important to note that these companies do much more than crypto-related business, meaning your exposure to cryptocurrency is diluted, reducing your potential upside and downside. Each of these methods varies its riskiness and exposure to cryptocurrency. So you will want to understand exactly what you are buying, whether it fits your needs.